You're listening to the Capital Stack Podcast, brought to you by BWE's Arizona Team, bringing you the latest capital market and lender news for commercial real estate. I'm your host, Ryan Denchev, and now for the latest market news for the week of August 1st. The Federal Reserve last Wednesday enacted another 0.75% short-term interest rate increase, making it the second consecutive hike over the past 2 months. The Fed's stringent action has come to address their interest in combating increased inflation that currently sits at a 40-year high. Fed Chairman Jerome Powell said at the meeting that restoring price stability is just something that they have to do, highlighting that the Fed is hyper-focused on bringing inflation down with a little less focus on the possibility that they stimulate a downturn to the economy. It was acknowledged that at some point soon, it would be appropriate to slow the pace of rate increases. However, right now, rate increase decisions will be evaluated on a meeting-by-meeting basis. In addition, the Fed decided to continue selling treasuries and mortgage debt securities that are on their balance sheet, a procedure that was authorized in their May meeting. However, the U.S. Treasury rate of sale will be doubled to $60 billion per month starting in September, and MBS rate of selling will increase in September to $35 billion per month. The roller coaster ride in Treasury yields continues after experiencing a continued downward rally earlier this week. The dip on the benchmark 10-year Treasury represented the lowest level since April 5th of this year. And now for the latest up-to-date lender news, kicking off with life companies. Life company pricing has remained steady over the past couple of weeks, yielding spreads in the 1.6 to 1.9 range for transactions with 60 to 65% loan-to-value. Lenders continue to push for transactions across all property types that will satisfy their different allocations for the year. Although volatility has remained in the headlines for the past several weeks, life companies continue to provide liquidity to the markets and capital to borrowers. They're leaders in the market when it comes to their ability to adapt to sponsors' business plans and rate lock at application, even in today's volatile rate market. And now, the latest on the agencies. Fannie Mae and Freddie Mac continue to respond to a flurry of business as their pricing has been amongst the most competitive in the market. Both Fannie and Freddie have reported healthy inflows, reviewing $2.5 billion in loan opportunities per week, ending out June at a monthly total of $7.4 billion. At this current pace, they will either meet or nearly reach their $78 billion per lender allocation goals for the year. Fixed rate continues to dominate at about 70% of their business, although acquisition lending opportunities are increasing as the market changes and they find ways to be more competitive there. New issuance Fannie Mae DUS MBS volumes are reported to be approximately $630 million over the first 2 days of this week, and Freddie Mac is said to be seeing active index lock activity as well. Traders continue to emphasize that clean transaction characteristics matter for the investors in this current environment and will receive the best executions. Now let's shift over to the latest news for the U.S. Department of Housing and Urban Development. A HUD 221D4 new construction direct-to-firm loan can reduce processing from 9 to 12 months to 6 to 9 months. This is available for market rate and affordable projects with experienced developers. HUD allows experienced development teams to submit one direct-to-firm application in the Section 221D4 program for new construction projects. Normally, the application process involves 3 stages: the concept, pre-application, and firm application. For experienced development teams where all parties, the developer, architect, and general contractor, have extensive HUD-insured or multifamily new construction experience, the second step is eliminated. Aside from developer experience, the direct-to-firm process is limited to projects which do not present with any environmental issues or other complexities, which would require more extended HUD staff reviews. Direct-to-firm could save the application up to 4 months of processing time if the plans and the specifications are at a biddable stage after concept. The timing for plans and costs is nearly always the critical path for completion of a firm application to HUD in the 221D4 program. Rounding out this week's lender news with commercial-backed securities. The CMBS market is in a rinse and repeat pattern as they struggle to win business due to the market conditions. All-in coupons remain at or nearly 6%, posing it difficult to win deals, although lenders may provide aggressive structures like full-term interest-only borrowing opportunities. The BWE network recently saw a quote on a large retail center that priced in the low 300s over swap. As we continue to face uncertainty and the increased risk, buyers of CMBS securities are likely to continue to force CMBS originators to remain wide on the market on quoted interest rates. Now let's quickly recap this week's latest update. The Federal Reserve has enacted another 0.75% short-term interest rate increase, making it the second consecutive hike over the past 2 months. The dip on the benchmark 10-year Treasury represented the lowest level since April 5th of this year. The agencies continued to respond to a flurry of business as the pricing has been amongst the most competitive in the market. Both Fannie and Freddie have reported healthy inflows, reviewing $2.5 billion in loan opportunities per week, ending out June at a monthly total of $7.4 billion. Thank you for listening to this week's Capital Stack podcast. For more information on what was discussed during this episode, reach out to BWE's Arizona Team. Contact info provided in the description.